Gold just posted its steepest quarterly decline in 13 years. To find a comparable drop, you have to go all the way back to 2013, the year of the so-called taper tantrum, when the Fed's own signal about winding down stimulus sent gold into a years-long slide. That's how rare a correction of this size actually is in the documented record. And then, within days of touching its lows, silver ripped higher by 11% in a single week, its best weekly performance since February, while gold broke back above $4,300. A move this size, followed by a snapback this fast, is not something you see every year, or even most years. Tonight I want to walk you through exactly what happened, how rare this specific combination actually is, when you look at the real historical record, what's different about this cycle compared to the last time gold fell this hard, and the honest caveat, because history doesn't always resolve the way you'd hope after a moment like this. Stay with me, because the full picture here matters more than the headline number. Section 1. The magnitude of what just happened. Let's start with the scale, because the numbers alone tell a genuinely unusual story. Gold hit an all-time high of $5,589 on January 28th of this year. By late June, it had fallen to briefly dip below $4,000, a decline of roughly 28% from the peak. On a quarterly basis specifically, gold fell 14.1% in the second quarter, its worst quarterly performance since 2013, 13 years ago. March alone saw gold drop $611 in a single month, the largest absolute monthly decline on record for the metal. Silver, true to its reputation for amplified volatility, fell even harder, dropping more than 52% from its own all-time high, above $121, down to roughly $58. Then came the reversal. On August 7th, a weak jobs report shifted rate expectations sharply, and within days, silver surged from around $58 to above $63, an 11% move in a single week, its strongest weekly performance since February. Gold climbed back above $4,300, its best level in roughly 2 months. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, compressed from about 69 to 1 down towards 67 to 1 in the span of days, a sign that silver was outperforming gold specifically, which historically tends to happen in the more forceful phases of a metals rally rather than a dying one. Put those two pieces together, a correction that's the steepest in 13 years, immediately followed by one of the sharpest weekly rallies in recent memory, and you get a genuinely rare combination. Most corrections don't reverse that fast. Most rallies don't follow a drawdown that severe within the same several-month window. Quick ask before we go further. If seeing this kind of move put in real historical context, rather than just reacting to the headline, is useful to you, hit subscribe, because we track these patterns as they develop. And I want to know, did you hold through the correction, or were you sitting on the sidelines waiting for exactly this kind of confirmation? Tell me honestly in the comments. I read every one. Now let's talk about what happened the last time gold fell this hard, because the comparison is genuinely instructive and not entirely comfortable. Section 2. What happened the last time this happened? Here's where I want to be careful, because it would be easy to cherry-pick history to make a point, and I'm not going to do that. The last time gold suffered a quarterly decline of comparable size was 2013, during what's remembered as the taper tantrum. The Federal Reserve signaled that year it would begin winding down its quantitative easing program, and markets sold off risk assets broadly. Gold fell sharply, and financial media at the time widely declared the gold bull market definitively over. Here's the uncomfortable part of that comparison. They weren't entirely wrong in the near term. Gold continued grinding lower for years after 2013, eventually bottoming out around $1,050 an ounce in late 2015, roughly 2.5 years after that initial correction. Anyone who bought the 2013 dip expecting an immediate recovery like the one we've just seen in August had to wait a long time to be right. That's the honest historical precedent, and it's worth sitting with before getting swept up in the excitement of August rally. A steep correction followed by continued weakness has happened before in the most directly comparable episode in the documented record. This is exactly why I don't want to hand you a guaranteed outcome dressed up as certainty. Section 3. Why this cycle is structurally different. Now here's why serious analysts, including the World Gold Council itself, have drawn a real distinction between 2013 and now, and it's grounded in what actually happened during the correction itself, not just hope. In 2013, central banks were only beginning to build the buying pattern that's now been running for over a decade. This time, central bank behavior during the correction was the opposite of 2013's dynamic. The People's Bank of China bought roughly 14.93 tons of gold in June alone, its largest monthly purchase since 2023. During the exact month, gold was posting its worst quarterly decline in 13 years. That's not a coincidence. That's a sovereign reserve manager treating a price dip as an improved entry point rather than a reason to sell, precisely because central banks operate on decade-long reserve allocation mandates rather than reacting to a single quarter's price action. In the World Gold Council's most recent reserve survey, 95% of responding central banks expected global official gold holdings to keep rising over the following 12 months. And newer buyers, including the central banks of Guatemala, Indonesia, and Malaysia, have entered the market for the first time, with the Bank of Korea adding gold exposure to its reserves for the first time since 2013. There's also a structural milestone that didn't exist the last time gold corrected this hard. The European Central Bank's June 2026 review confirmed that gold has overtaken US Treasury bonds as the world's largest reserve asset for the first time in roughly 3 decades. That's a genuinely different backdrop than 2013, when Treasuries still sat unquestioned at the center of global reserve holdings. On the silver side, the structural case is arguably strengthened rather than weakened through this correction. The Silver Institute projects 2026 will mark the 6th consecutive year of a global supply deficit, now projected at 46.3 million troy ounces, up from 40.3 million the year before. Since 2021, the silver market has drawn down a cumulative 762 million troy ounces from above-ground stockpiles just to cover the gap between mine supply and demand. None of that reversed during the correction. If anything, it kept building quietly underneath the falling price. I want to be direct about the limits of this comparison, because drawing too clean a line between this time is different and here's your green light would be doing you a disservice. First, one sharp weekly bounce, even an 11% move in silver, does not undo a correction of this magnitude on its own. Gold and silver both remain meaningfully below their January highs, and a single week of strength following a jobs report doesn't settle the longer question of whether the correction has fully run its course. Second, the 2013 comparison cuts both ways. Yes, the structural backdrop looks different this time, with far more aggressive and broader-based central bank buying than existed in 2013. But 2013 also looked, in the moment, like it had reasons for optimism that didn't prevent 2.5 more years of decline. Anyone telling you with certainty that this time resolves quickly and cleanly is giving you more confidence than the historical record actually supports. Third, the near-term catalyst that triggered August bounce, a weak jobs report and shifting Fed rate expectations, are exactly the kind of data that can reverse just as quickly as it arrived if next month's numbers come in differently. What's fair to say is this: the magnitude of this correction and the speed of its recent reversal genuinely is rare by historical standards. The structural backdrop underneath it, central bank buying, the silver supply deficit, gold's new position as the world's top reserve asset, is measurably different from the last comparable episode in 2013. That combination is worth taking seriously. It is not on its own a guarantee of what comes next. Here's what I want you to walk away with. Gold just posted its steepest quarterly decline in 13 years, a genuinely rare event by the documented record, and within days of bottoming, silver staged its strongest weekly rally since February, while gold reclaimed a 2-month high. The last time a correction this size happened, in 2013, it took roughly 2.5 more years before gold found its actual bottom, an honest reminder that rare doesn't mean resolved. But the structural backdrop this time looks measurably different. Central banks buying through the correction rather than pausing, gold overtaking treasuries as the world's top reserve asset for the first time in 3 decades, and a silver supply deficit that kept widening the entire time prices were falling. I want to hear from you. Given the 2013 comparison, do you think this correction resolves faster this time because of the structural differences, or do you think the near-term bounce could stall the way it did back then? Tell me honestly in the comments. I read every one, and it shapes what we cover next. If putting this move in real historical context, instead of just reacting to the headline, was useful, subscribe before you go, because we'll keep tracking exactly how this compares to what's happened before.